The main thing that's made me kind of concerned about the interest rate component is purely I think the time frame that it would take to complete a renovation on this triplex that we've that's been like the sole property. We've crunched all the numbers and we've looked at a few others. But the interest rates going up every 2 months or every 3 months, if this property were to take 2 months, 3 months for a complete gut and rebuild, basically, that's kind of what's been hanging over my head as far as the time frame of what it looks like to get that project done in that kind of time.
Yeah,
so that is super
yeah,
helpful.
that's fair. So in that specific situation, you really have two things to consider. One, what are your interest rates going to be? And two, what's your ARV going to be? Because one of the luxuries that BRRRR investors have over flip investors is when you flip, the market's more dynamic than appraisals would give you. Appraisals are a historically informed number of the value of your property. It's not a snapshot of the value of your property because it's looking back 3, 6, 12 months, depending on market volatility and the appraiser you use. But if you're just flipping a property, if your market becomes really, really hot, then instead of your ARV being 150, you could sell it for 180. But the opposite's also true. And right now, that's one of the challenges is you either leave it on market longer, you got longer holding costs and more risk, or you drop the price and you sell it lower. So it's a little bit more dynamic for flippers. For BRRRR investors, there's a little bit more protection, but you still have a similar risk in that when you're evaluating the ARV of a property, you're looking backward. So you're looking for sales for the last 3-6 months that are comparable to your property. And that's what your appraiser is going to do. So if you're looking, usually they'll use a 6 to 12 month window. Really, I like to bias toward recency, because if you're looking in the 3 to 6 month window and your rehab is going to take 3 months, now that 3 to 6 month window is a 6 to 9 month backward look. So it's still helpful data points for your appraiser to use. Instead of, if you looked at something that was all 12 months ago and then your rehab takes 6 months, they're not really going to consider something, data from 18 months ago, right? So you've got two pieces. One is interest rates changing, and two is, will your property value go down or up? And that's going to be dictated by the property value is going to be dictated by each local market. And so if you're looking at, you can get some of this information from your agent, but if you're looking at properties and you're seeing them drop in price, that's not necessarily a bad thing, because previously what would happen is, say in 20 or 2021, mostly 2020, you'd have houses listed at 150 and they'd sell for 175, right? And right now they're being listed for 200 and they're having to drop it down to 175, right? So it's not exactly a perfect, just because prices are having to drop doesn't mean that total median price is going down. It could, but that's not a safe assumption to make, because the illustration I just gave could be true. So I would rely on some information from your agent to figure out, are we seeing not just sales price drops, but overall median sales price go down on properties? And if so, how much? Should I build in like a $5,000 buffer for what I think my ARV is going to be? It's not going to be a 30% difference. So you've got a little bit of safety there. But as you're looking at your ARV, you want to give yourself just a little bit of buffer, and then decide, is the upside of what I think is probably going to happen or is likely to happen worth the small potential that this downside might happen? And so it requires you get a little bit better at your risk analysis evaluation. So those two things are the things that I would look at a little bit more closely: your future value, your ARV, and make sure that your comps that you're using are biased toward recent, and your rates. And so with your rates, you could assume if it's going to be done in the next 3 months, worst case scenario, we've got 2 rate hikes, and it looks like this next one's going to maybe be either a 1/4 point, or maybe they don't raise it, but I would bet that they go up a 1/4 point. And then the worst case scenario would be another point. All right. So you take what quotes you're seeing today for rates, add a point, and then see if the numbers work there.